A very good morning to you all of students. So today we are going to discuss our revisionary aspects on derivatives. So this is a live session. If all of you or have some of the queries, please do put it on the query handle so that we can discuss on those. Plus we will do the revision on the derivatives topic. So I will start with the flow. I will start with the revision, the topics that we have covered in detail in the class. And in case anyone wants to have a specific query in that, please do let me know. Or any question that you want me to again repeat, please also do let me know. Questions I would not be covering in this session. I would only be covering the concepts. Good morning, Viraj. So let's discuss with the starting on derivatives that we discussed. We said that there is A, which we regarded as a financial instrument. Now, what do we meant by financial instrument? Instrument is something called as a contract, and financial, which involves the monetary payments or receipt. So we said that if A is a derivative and A will not have its own value, A will always derive its value from its underlying, which is B in this particular case. So we said that for derivatives to happen, first of all, the foremost condition is that it will not have its own independent value. It will always derive its value from any of the underlying, and hence it is called as derivative because it is deriving the value from an underlying. And what is A? A is a contract. So I just want all of you to understand A is not a security. I mean, it's a security by the definition of securities, but it's not a physical form of security. It's just a contract. It is simply a contract which says that it will derive its value from its underlying. Now, we said that, okay, A we will come to later, that what types of contracts can be A. Types of contracts we have discussed further, but first we thought of elaborating that what can be types of underlying. What are the different types of underlying? So we said that underlying can be many things, not only those which I have listed here, but apart from these also, there are a lot of other underlyings. So the first underlying is the equity. By equity, we mean equity shares. This is a very common example, right? For example, X Limited as a equity share is trading in market, let's say on Bombay Stock Exchange or National Stock Exchange. For that X Limited equity, there will be a derivative trading in the FNO market. Or let's say there is a derivative that will be there in the over-the-counter market. Correct? So what we are trying to say is that possibly X Limited's or Y Limited's or any other company's equity can act as an underlying for some of the derivatives. Similarly, on index part, we said that not even single company's equity, but a collection of or a portfolio of companies index, for example, BSE, NSE, even they also can act as an underlying, because all of us know that BSE and NSE have a value to it. NSE also have Nifty. The index name is Nifty. BSE has an index name as Sensex. So Sensex has an underlying and a derivative which is deriving value from that Sensex is called as a derivative on BSE index. Similarly, if Nifty is there and there is a derivative on Nifty, that means that the derivative is deriving its value from the movements in Nifty. Hence, it is called as derivative on index. And not only this, what we have seen is there are a lot of different indexes also, because BSE and NSE would mean the entire India index. But there are geographical, there are industry specific index also, which are there. So for them also, if there is a derivative and it is deriving value from those indexes, it is called as an index based derivative. And the underlying is index. Third category, we said that now if you can imagine, we have covered equity, we have covered indexes, which is a collection of equities, and forex. Now, the another important aspect in all the commercial transactions, if it is happening beyond, if it is happening cross borders, it is forex. What is the USD to INR rate happening? So there is a spot market, correct? There is a spot market in which you can go and buy USD or sell USD on spot at the rate that is there in that market. So that market has a forex rates even for GBP, even for any other currency you can think. So derivative on forex is something which derives its value from these forex markets on different instruments. Correct? So derivative can also be on forex. Similarly, derivative can also be on commodities. This is very good example. For example, what are commodities? Commodities are sugar, oil, which are homogeneous, right? And even metals. So in this case, if we will take an example also to elaborate it further, but just to tell you that even commodities will help a financial instrument drive its value, and hence it is called as a derivative because it can also be a commodity. Apart from this, these are all financial aspects, right? These are all financial underlines, I can say. Equity, index, and forex are definitely financial underlines. There are other non-financial underlines also. For example, weather. A derivative can also be on weather. So it can be on a lot of things that are beyond our, that maybe beyond our thoughts. Correct. So the market is such evolved that anything and everything which has an uncertainty attached to it, which we don't know that what is going to be an outcome, that is acting as a derivative. Sorry, that is acting as an underlying to some of the derivative. Okay. Good morning, Namrata. Now so this is the very basic of derivatives, correct? Where we said that derivatives don't have their independent value. They will derive its value from an underlying. Now we came to some of the features of derivatives. So the first feature we said that, like any commercial transaction, derivative will also have two parties, at least two parties, which are primary parties. One is the buyer of that derivative and one is the seller of that derivative. Now, whenever I say derivative, students, please keep in your mind that I'm talking about that contract. Okay, so this contract, this financial instrument contract, which is this A, which I have put like A as a contract. So I'm talking about this contract. Okay. So this contract has some of the features. Now, what are the features? There is a buyer of this contract and then there is a seller of this contract. Correct? I can buy and sell the contracts. This is a financial instrument. And hence we are saying in our context, it is a derivative. So someone will buy derivative and someone will sell derivative. Now, for A, which is the derivative itself, let's say buyer is Mr. X and seller is Miss Y. However, for the underlying, here what I want to emphasize is that underlying is separately getting sold and purchased in the separate market. But derivative is having a separate market for which there are different buyers and sellers. Okay. So the buyers and sellers of an underlying are essentially not same to that of the buyers and sellers of the derivatives. Okay. So these are two different markets. Two different markets. These markets are not same. You would have heard of, there is a FNO segment. Correct? And there is a equity segment in any of the stock exchange. FNO means futures and options. Equity means the spot market. Okay. Now, second feature. So I think first feature is very clear that there has to be a buyer and there has to be a seller, then only the contract will complete. Otherwise, with whom we are making the contract? This is a very normal understanding. Second, the value of derivative is dependent on the value of underlying. This also we understood through our previous discussion. That the derivatives will not have their own value. They will have to derive the value from the value of the underlying, which is also clear. Now, this is very important. Third feature is very important. It says that there is an expiry of A. A here is the financial instrument, contract, derivative, by whichever name you want to call, because in my previous slide, I have taken it as financial instrument as a A. So it has a limited life. It has some sort of an expiry. It is not an open-ended contract. It has an expiry bound contract. For example, 3 months. So this contract is only valid for 3 months. Now, up till 3 months, if happens, then it is fine. If it's not happening, then it is lapsed. Okay. We will cover on the expiry part later. I will link it back again to here saying, what are the different aspects on the expiry of a financial instrument. Okay. And how it is relevant in the overall functioning of a derivative. Yes, Namrata, there are different markets for derivative and for the spot markets. Value is dependent on the underlying. Yes, the derivative's value is dependent on the underlying, and definitely there is an expiry of the financial instrument, which is the derivative. So Namrata is asking, underlying on which value is dependent also have an expiry. It might be possible, it might not be possible. Now, if you understand from the different underlyings, for example, equity will not have an expiry. Similarly, index will also not have an expiry. Forex and commodity. All the 4 examples that I have taken here, none of them will have an expiry as underlying. But their derivative contracts, which derive its value from these underlyings, can have expiry. Okay. So to answer your question, underlying, at least what we are discussing, will not have any expiry. Okay. Now settlement. Payoffs for buyer and seller. Now on settlement, what will happen? Either buyer will pay to the seller or seller will pay to the buyer. Correct? One will gain and one will lose. One's gain is the another one's loss. Now we will also understand how the settlement is computed. What are the ways and means to finalize the settlement and accordingly derive the gains or loss for buyer or seller. But as of now, one thing to be kept in mind, that on expiry or before expiry, the settlement has to happen. Otherwise, the contract will not be executed. Correct. So everything we can actually classify under 2 buckets. There are certain things and there are certain things and there are certain uncertain things. These are uncertain things and these are certain things, which are actually specified, and these are variables. Now, what are specified? First of all, in the contract, it has to be very clearly mentioned that what is the underlying asset that we are talking about. We're talking about the derivatives contract. Okay. So in a derivative contract, it has to be specified that what is the underlying asset. What is the quality of that underlying asset? Now, for example, I am actually dealing, or let's say I am making a derivative on oil. So that oil has to be grade A oil, grade B oil, grade C oil. That has also to be specified. Because that quality of underlying different grades will have different prices, and hence there will be 3 derivatives, grade A, grade B, and grade C, like that. Okay. Then whether the time period is 3 months, 6 months, 9 months, 1 year, more than a year, that also has to be very clearly specified in the contract. So these things are already fixed. Now, what is not fixed? The price of the financial instrument, or the value of the financial instrument, which is called as a derivative. So then we come to types of derivatives. Yes, Namrata. Quality have different prices. Yes, just like we discussed. Different quality grades will have different prices, and hence it is very clear in a derivative to specify what quality are we talking about. Okay. Now, so till now we have discussed certain things on underlying, what can be types of underlying, and some of the features of a derivative. By features, we mean what are the bare minimum, let's say operational requirements for a derivative. Okay. Now let's come to types of derivatives. So the first one is forward contracts. So these are really very, very important. So please do hear me out carefully. Although we have discussed in detail in our previous sessions, this is just a revisionary session, and hence I would be taking up the revisions accordingly. Okay. So Namrita is asking, can you give an example of quantity of underlying is fixed? Yes, Namrita, as I told, for example, okay, what we will do, we will cover that through this forward contract discussion. Okay, Namrita, because in this example itself, I have taken quantity also. Okay, so we will cover that. On this forward contract, let's start our discussion. We, first of all, don't get confused with the terms here, forward contracts. Let's first of all try to understand through this one of the case study. So what I said that, let's say there is a procurement manager in a company. Okay. And he or she wants to purchase crude oil. Okay, because it is one of the inputs that goes in the manufacturing of some of the finished products, and hence they are in need of purchasing the crude oil. They want to purchase a grade A crude oil. They always take a grade A crude oil with 20 liters as quantity. They as of now need 20 liters quantity, but they need it after 6 months. Not today, they need it after 6 months. Because it can happen, right? Because essentially we do forecast. We do that, what is the requirement of a crude oil from now after, let's say, 3 months, 6 months. So the requirement is after 6 months, we are going to undertake some of the production for which we need crude oil at grade A, and that too at 20 liters. So this is an underlying, correct? This is quality and this is quantity. Now, as a procurement manager, the first and foremost objective of a procurement manager is to purchase at the lowest prices available for grade A crude oil, 20 liters, correct? So what he or she is trying to analyze is, that today the price, I have taken all this as an example, okay? So let's say today the price is only 100 rupees. I don't know what is going to happen after 6 months. But I certainly know that in the global markets, the condition is such that the prices are actually going up, and it will continue to go up till 6 months from now. Correct? So what action what action that procurement manager should take? Now, if you understand, you cannot purchase and keep it now. Why? Because you need storage to keep that. You will block your working capital for 6 months if you're purchasing it now. So hence, what is the right thing to do? Now that procurement manager goes to a supplier. Okay. This is the procurement manager and this is the supplier of that crude oil. And it says that, look, I want to purchase grade A crude oil, 20 liters, 6 months from now. Today price is 100, but I need it after 6 months. So let's lock the price now. Let's fix the price now. And you deliver me after 6 months. Sorry. Sorry. Yes, Amrita. This is a grade A quality fixed, 20 liters is quantity fixed, and expiry of the contract is 6 months. Sorry. And the underlying is crude oil itself. You're right. If we purchase it now, it will impact our inventory cost, and we don't want that. And supplier agrees to it. Supplier says, okay, today is 100. Even after 6 months, as per the estimates, this goes up. It will be going up to 110 or 109 only. So I'm okay to sell it at 110 and fix the price as of now. So this contract is called as a forward contract. Now students, see the 100 and the contract to buy. Okay, now let me just clarify here. Let's put here contract to buy crude oil after 6 months at the rate 110. This contract is a forward contract. The transaction has not happened. The actual transaction has not happened on day 0. Correct. So it is just a promise. It is just a contract. It is just a contractual rights and obligations to execute after 6 months at the rate of 110. So this is called as, forward contract. We will discuss it further. Now, let's come to the situation, what happens after 6 months. Because after 6 months, the prices can go up, can go down, or it can be same. Now, the price, in the case 1, we have assumed the price is 115. If the price is 115, don't you think procurement manager has done a very good deal? Because if this forward contract was not available, their company would have lost 5 rupees on 20 liters. Correct? So hence, since they have, because of this contract, they are able to save 5 rupees per liter. Because the negotiated price is 110. The outside market price is 115. Correct. Similarly, supplier will face a loss because supplier, had it not been entered into this contract, he or she would be able to sell it at 115 rupees. Now they have to sell it at 110. That is where is the losses. Now let's say the price has come down to 95. This is a case 2. Now, in case price has come down to 95, what procurement manager is thinking? Procurement manager is saying that 95 is the rate at which I could have bought from outside, but I have a contract to buy at 110. That means I have incurred a loss of 15 rupees because I have to honor this contract and I have to pay 15 rupees extra to purchase this. Similarly, supplier would say that outside I would have been able to sell at 95 only. But because of this contract, I'm realizing 110. So there is a gain of 15 rupees. So Namrata is saying it means in this contract, while entering into the contract, the buyer view is that the prices will go up. Yes, whatever we are fixing now, and seller view that the prices will not go above the contracted price. Yes, I just want you to correct one thing in this, Namrata. The seller's view is that the price will go down. And buyer's view is that the price will go up in this particular scenario. Okay. And case 3rd, if 110 is there is no impact to both of them. Now, the settlement part. Settlement part, how it will happen? Procurement manager will pay 20 liters multiplied by 110, 2200 rupees to supplier. Supplier will deliver 20 liters of crude oil to procurement manager after 6 months. Forwards are over the counter contracts. Now there are, I mean, this over the counter term means that over the counter means over the table. So both buyer and seller are sitting on a table in front of both of them, and they are doing this deal, which is customized, which is not a standard one. If had it not been customized and had it been a standard one, it would have not been over the counter. It would have been traded in the exchange market. Correct? That we will see in case of futures. So that's what we said, that these are highly customized to suit buyer and seller. It can have any quantities. It can have specific quantities. It can have specific quality. It can have those things. Now coming to futures. So just like forwards, futures are also one of the type of the derivatives. Yes, Namrata is saying forwards can be specific to the buyer requirements. Yes. Even seller can have some terms put it into the contract. So for futures are those financial instruments which are actually standard contracts. Okay. They have a standard lot size. They will have a standard underlying. And on this, the settlement always happens on net basis. There is a net payoff. There is no actual delivery required in this case. In forwards, the actual delivery of underlying has happened and the actual payment of the gross amounts also has happened. But here only the net basis settlement will happen. That we will see how it will happen. And futures are mostly traded on stock exchanges. So we are saying that futures are always similar to that of a forward contract, except for these three differentiating factors. One is that these are standard contracts. Second is it will be settled on net basis. And third, they are traded on a stock exchange because they are standard, they are homogeneous, and hence they can be traded on a stock exchange. Now, through this, we have tried to explain how the functioning of a stock exchange happens. So on a stock exchange, X will place a request to buy specific future. Now, again, students, future, let's say there are 10 to 15 companies, different companies, there will be 10 to 15 different futures. And again, one future will be 1 month expiry, second will be 2 months, and third will be 3 months expiry. So at a given point of time, there are 3 futures of the same company in a stock exchange. 1 month expiry, 2 month expiry, and 3 months expiry. And all of these expiries mature on the last Thursday of that particular month. So it's a very interesting thing. You can also go and check this. In the F&O segment, for all the futures, last Thursday is the settlement date for all the futures that are outstanding. Similarly, Y will also place the request of selling the futures because as I am selling or buying the equity shares, I can also sell or buy on the stock exchange futures on those equity shares. Okay. Now let's come to the settlement. Now Kaushik is asking why last Thursday. That answer I might also not have, Kaushiki, that why they have picked the last Thursday. Okay. So, but this is one of the fact that all the settlement of futures happens on last Thursday of that particular month. On the settlement part, So X will buy and Y will sell. That is what we have specified as parties, and prices are also listed here. And we have said that 110, I think we are continuing, we were continuing in the same example, that there is a deal done at 110. X has placed a buy request of future at 110. Y has also placed a selling future at 110. Their deal is done. Prices are matched. Deal is done. So X has entered into a buying position. Y has entered into a selling position. Now, if the price is 115, simply on maturity, we are saying this is on maturity. Okay, so on maturity, if the price is 115, X will gain 5, Y will lose 5. Why? Because X holds a right to buy underlying at 110. Will get 5 rupees from Y. In case 2, X will pay 15 rupees to Y. I hope this is clear. Okay, students. I think this we would be discussing something on T+2 settlement. Okay, so I'm skipping this. Now, can we do some of the back calculation and try to see that whether we should purchase, whether we should buy, or whether we should sell? Okay. In what situations we should take a call that we have to buy? Whenever we have a let's say knowledge that prices are going to go up in the market in the time to come of, let's say, security X limited. Okay, then you will buy. If prices are going to come down, if you're in anticipation that prices are going to come down, then you will sell the security, although you're not having it, and then you will purchase the security. Okay, let me explain in detail. Just a second. Yes, Namrata. Namrata is saying actual gain, but only gain is transferred. No, there is an actual gain and actual loss. So Namrata, if you see in this example, this 5 rupees is an actual gain. This one. And this 15 rupees is an actual loss. 2x. Okay. And for this, the actual inflow and outflow of the cash will also happen with the bank account. Okay. Yes, Namrata, you're right. We will buy and sell the security. Now, in the first case, let's first concentrate on the first case. You know that prices are going to go up. So the first step you will take, you will buy that security. And then once the prices are going up, then you will sell the security. This is a very normal thing because first you have to buy and then you will only be able to sell. So by this, you will be able to make good amount of profits. Correct. Now, what if you get to know that prices are going to go down, or let's say you have done your calculations basis which it is very clear that the prices are going to go down in the time to come. So don't you think that in this situation also you can make some good profits? Yes. First, you need to sell that security today. Yes, that is very much possible. Yes, Namrata, I am taking it a little bit slow only. Okay. So what I'm saying is that you know that in future the price is going to come down in the time to come. So what you will do, you will sell the security, and once the prices comes down, you can purchase back the security. Let's say today the price is 200. So you have sold the security at 200 today. And let's say this is after 3 months. 3 months, the prices has come down as you would have calculated, or as you would have anticipated the prices to come down. The prices have come down after 3 months at 150. At this price, now you are purchasing back the security. This is also very much possible. But I will come to the legal aspect of it later. But so in this particular case, 200 minus 150, 50 is the profit that you have earned. So this aspect is called as short selling. We call this concept as short selling, where we are selling first and buying later to take an advantage of the price going down. Now, what I was saying is that the short selling is not allowed in the spot market. Legally, this is not allowed. So if you see, I've put it here. This is a spot market equity traded and this is futures traded derivative market. So case one is allowed in both the markets. Buy first, sell later. This is a simple case. Case two, which is the short selling. So in spot market, it is only allowed within the same day. So morning you sell and evening you buy. But within the same day, you will have to close your position. In this case, it is allowed intraday also. So today you sell and after 2 months you buy in the derivatives market. Correct. Because in derivatives, essentially, if you sell it, you are not going to give any delivery. The settlement happens on net basis. Okay. I hope this is clear. So through this case too, I was trying to explain you that what is the meaning of short selling. And I was trying to say that in derivatives, you can still sell first and buy later. However, in the spot market, you can't do that. You always have to first buy and then only you will be able to sell. Okay, students, I hope this is clear. So this is again the example, or let's say the discussion that we would be having on spot and derivatives. Spot market, we said that selling first and then purchasing is not allowed because you will have to give the actual deliveries. If you don't have stock, what are you going to deliver for spot market? But derivatives, selling futures, and after 1 month you can purchase it because you are not required to deliver. As I said that settlement in case of futures happens on a net basis. Correct, students? So if the settlement is happening on a net basis, then there is no need of delivery. Only the net amount will be paid or received. Okay. So Namrata is saying we have to buy from anybody or we have to buy from the person to whom we have sold later. You can buy from anyone because it is your position. You don't have to buy it from the same person to whom you have sold. It's a market, right? So you can sell it to A and you can buy it from B. It's not person specific, it's instrument specific. So that instrument you have to sell and buy. Okay. For completing the short sell. Then through this 3 buckets, we have actually compared how a cash segment spot market looks like, how a forwards instrument would look like, and how a futures instrument would look like. Cash segment, spot market, what we say is the underlying segment. So why we say this is a cash segment? Because the cash has to be settled here. Correct? It's for the actual delivery. Forwards, these are O2C customized contracts. And in this, 100% settlement and delivery happens. Futures, on the other hand, these are standard contracts which are traded on stock exchange and this is settled on net basis. I hope this comparison is useful. Then comes another issue on compounding. So through this, we have revised our compounding formulas. First of all, we said that A is a future value, P is a present value. And if we have to find a correlation, we have to multiply present value with 1 plus r raised to the power t. That is a compounding formula. If 18% is the rate of interest for 1 year, then time is equal to 1. And hence the formula will be A is equal to P1 plus 18% raised to the power 1. Correct? I'm just removing it. We will explain it later. So A is future value, P is present value, and R is annual rate of return, and T is the time period. So 1 would be for 1 year. Now, if it is semi-annual compounded means, see, in the above example or in the above case here, we are assuming that compounding happens annually. Correct? So what is the meaning of compounding first? Compounding means that the interest is also charged on interest. Interest is not only charged on the principal, but it is charged on principal plus interest both. Correct? That is what is compounding is. But what is the frequency of adding interest to the principal and then again calculating interest on that? That frequency is called as whether it is a semi-annual compounding, annual compounding, or what. So that frequency in this case is the annual compounding. Here, it is a semi-annual compounding. So every 6 months, the interest will get added to the principal, and on that, again, the interest will get calculated. For example, 100 plus 5, 105, this is the 6 months interest. After 6 months, the principal becomes 105. Now, on that 105, the interest will be calculated for next 6 months. That becomes, let's say, 6. So it will become 111. Right. So then again, 111 will be taken, and on that interest will be taken, which is, let's say, 7, which becomes 118. So after every 6 months, interest accrued gets added to the principal, and on that, the compounding happens. Compounding means that interest is calculated on the previous accrued interest also. Interest is not getting calculated only on the principal. That is called as simple interest, and compounding interest is this. So here it is half years. The formula remains same, but what we will do in this case, annual rate of interest, we will divide by 2, and time period also we will take it as 2, because first compounding will happen on this after the 6th month, and second compounding will happen after the 12th month. So A will give us the value after 1 year. So this is the formula that we have put. A is equal to P1 plus R divided by N raised to power T into N, where R is the percentage, T is time period, 1 for 1 year, and N is equal to number of times compounding in 1 year. Okay, students? So we have taken R is equal to 10% and time is 3 years. Compounding happens 4 times per year. That means after every 3 months, the compounding happens. So that means N will become 4, time T will become 3, and R will become 10. So substituting all these things in the formula, this is our revised equation. %10 divided by 4 raised to the power 3 into 4. Correct? Because 3 is T and 4 is N. Okay. Now, this was really interesting. Continuous compounding. Now, some of you might think that why we are even taking 6 months, why we are even taking 3 months, why we are even taking 1 month, why we are even taking 1 day. we should actually take every second for the compounding. So every second, so what should happen essentially? Let's say 100 is there and 0.01. This is, let's say, interest for 1 second. It becomes 100.01. Immediately after 1 second, the amount due becomes 100.01. Now on this 100.01, the interest should be charged for second. I mean, the next second, not second, the next second, it should be charged on this amount. So this is called as continuous compounding, because continuously the compounding should happen. And I am telling this second, but this is actually not second. This is infinity. Okay, so infinity means which cannot be basically quantified. Correct. So I'm just taking a second as a metaphor here, but it's not really a second. It's even very less than a second. Okay. So for this, we use this formula. A is equal to annual value is equal to P, which is the present value, multiplied by e raised to the power r into t. So E is a constant. Raised to the power r and t is the r is the percentage per annum and t is equal to 1 here. Yes, Namrata, compounding even happens for 1 day also. In the in the interest rate derivatives, there is a concept called overnight index swap, OIS. In that, the compounding happens every day. Okay. So interest on what amount is calculated? Interest will always be calculated on the previous outstanding amounts. But this formula actually simplifies the approach. This formula, if we take e raised to power rt multiply in the present value, it will give us the future value with a continuous compounding. Okay, students. Now comes the valuation of a forward or future. Because we have to understand these concepts first on the continuous compounding, semi-annual compounding, yearly compounding to arrive at the valuation of forwards or futures. So students, we all know that present value is coming from the spot price or from the spot market. Kaushik, E is a constant. As I told here, E is always a constant. Okay, so E raised to the power RT, you need to find out the value from the facts that are given in the question, or let's say the table extracts that would be given as a part of the question. Okay. We will discuss that. I will tell you because we will have some elaborative discussion on E going forward. It is used in the Black-Scholes model as well, the reverse of E. Okay. So the present value, spot price, we have to arrive at the future value because that is what a derivative is. Derivative derives its value from the value of from the price of the underlying. So the price of a forward or future, the pricing technique remains same for both, is equal to the future value of spot price. Correct? And that future value has to be calculated basis the time period which is mentioned in the expiry terms. Correct. And now with our previous knowledge, we know that there are two types of compounding. One is discrete compounding and one is continuous compounding. Discrete compounding is annually, semi-annually, quarterly, daily. That is called as discrete compounding. Continuous compounding is where we are compounding for the infinite times. Okay. So let's say today is 3rd December and spot market Forex Limited is showing up a value of 10. Okay. And derivatives market for futures on X Limited is showing 3 different derivatives, 1 month, 2 month and 3 month. So the first month derivative is going to expire in December 21, which has a value of 11. 10 has a 11. Jan 22, which is the second month expiry, will give a value of 12. And third month expiry will give a value of 13. Correct, students? I'm just trying to tell you through an example that the future value will be higher in case the expiry is also higher. The time period to expiry is also higher. Correct. So 11 is a future value of rupee 10 after 1 month from now. It is very simple. So if we are given the spot price, we will just simply put instead of P and take the interest rate and multiply these factors to arrive at the future or forward value, which is called as A in this case. Yes, Namrata, it is just time value of money. Treatment of dividend and transaction cost. Now, these are the two different nuances or two specific considerations that we have to keep in mind while we are treating or while we're calculating the future price. So first of all, there is a discrete dividend. In case of discrete dividend, now what is the meaning of discrete dividend? First of all, discrete dividend is the dividend which is payable at a point of time. Let's say interim dividend once in every 3 months. This is called as discrete dividend. Interim dividend on September of every year. This is also called as a discrete dividend. Now for doing that, from the price, you always reduce the present value of dividend and multiply it with again 1 plus r divided by n and raised to the power t into n. So only dividend is adjusted in the price by taking a present value. Now this we understood with the help of example. Let's say we are trying to find out 3 months expiry future price. On second month, after second month, there is a dividend expected of 50 rupees. Correct? So what we will do? From this spot price, which is P, we will reduce present value of 50 rupees and then just simply multiply the compounding formulas. Okay. Now then comes valuation of futures. In case of transaction cost. First of all, students, note, we are not talking about valuation of shares here. We are only talking about valuation of futures, okay? So if there is a transaction cost, then we will add back that present value of transaction cost to the original price and reduce present value of dividend and just do our calculations normally, okay? Now comes the case of continuous dividend. So students, before continuous dividend, we have also discussed in case there is a continuous compounding, but the dividend is discrete. In this case, compounding is continuous and dividend is discrete. Correct? That is the case we are saying. So if dividend is discrete, we will reduce it present value, and since compounding is continuous, we will take this e raised to the power r into t. Now let's come to the case of continuous dividend. The case is very simple. We will just take a is equal to p e raised to the power r minus y. So y is the dividend and r is the return. So with R, the future value will keep on increasing. With Y, it will keep on decreasing. So Namrata is asking why we have reduced dividend. Namrata, with a very simple theory that in case the dividends are proposed to be paid, ultimately your current prices already includes those dividends. And the second logic to reduce this dividend is in futures or in forwards, the dividends are not paid. The dividends are paid only on the underlines. So why would we take into account the price of the future, a dividend value which is never going to be paid on a future? Okay. So hence we reduce dividend while always we value our futures, because companies don't pay dividends on the futures that are traded on their equity shares. Companies always pay dividend on their equity shares itself. Namrata, this part of dividend is discrete or continuous will be given in question. Question will specify that dividend is accruing continuously at the rate of 7%. So by this, you understood that this is a continuous dividend, or it will say that dividend is generally paid after 2 months at the rate of 50 rupees. This is a discrete dividend. Okay. Now, another thing, price of future is equal to the spot price when it will be equal on expiry. So the future value is future price, present value is spot price. The moment futures go or approach the expiry, the future price tend to come down to the spot price. So let's say here we are saying there is a 1 month, 2 month and 3 month. After 3 months, it's going to be expired. So the first month, the futures will be higher. It will slowly, gradually coming down. And ultimately, it will be equal to the spot price. Okay, so on expiry, always your futures price will be equal to spot price. Why? Because T is equal to 0. Time to expiry is 0, correct? And hence, the interest portion will also become 0 in the calculations. So then I think these are some of the questions that we discussed. Again, this is something to be understood and kept in mind while we are going through the entire curriculum. What are different positions? One is buying position, one is selling position. Buying we also call as long position. Selling we also call as short position. We have already understood what is the meaning of short selling. Who is a short seller? Who is taking a long position, which is a buying position, correct? All these things needs to be kept in mind. Then spot market, cash market, which is also called as in the market in which delivery happens. Derivative market, in which the net settlement happens, correct? Now, please understand there is a difference between one future and one contract. One future is where one future is there. But one contract is a contract which has a lot size of, let's say, 1,000 futures. It can be 2,000, 3,000, it can be anything. Good morning, Anandi. Then comes what are the uses of these derivatives. So students, till now, we know that what is first of all the meaning of a derivative. What are the basics of derivative? What are the features of derivative? We have then studied two different types of derivatives, forwards and futures. Forwards are over-the-counter customized contracts for the needs of buyer and seller. Futures, on the other hand, are standardized contracts that are exchanged on a stock exchange which have standard terms and conditions with regard to price, with regard to lot size, with regard to underlying, with regard to even the expiry of the contract. Then third concept that we studied is on the valuation of these futures slash forwards. So whether it is a future or forward, the valuation principle remains same. And what is the basic principle on the valuation part? The valuation is always handled through the future value, which is the present value multiplied by the interest component, which gives us the future value. Okay, students? So Kaushik is asking, in actual spot price increase, so future price is equal to spot price. No, Kaushiki. Now Kaushiki has raised a very valid question. Let me explain here. Let's say there is a 3 months expiry future. Okay. Here the future price was, let's say, 100. Here the spot price was, let's say, 90. Okay. And this has a 3 months expiry. Now let's say after first month, the spot price has become 95. Correct. So Kaushik is saying in actual the spot price increases. Let's say it increases from 90 to 95 after 1 month. So Kaushiki and everyone else, the future price in relation to 95 will also increase. Because again, the future will derive its value from the spot price and it continuously derives its value. It is not that on the inception of the contract, it has derived its value and it will always remain 100. No, it will keep on changing. Then let's say here, the spot price becomes 85. The future price will become 90. And ultimately here, the spot price becomes 92. Let me not take 90. Spot price becomes 92. The future price will coincide with 92. Okay, students. Thanks, I think, Kaushiki, for for raising this question, because this is a very important one. Okay. So don't think that the future price is an absolute fixed value for the entire period. No. In market, it will keep on changing. Because the underlying changes, the future price will also change in response to that. Namrata is asking, in short sale, when we sold, then we'll get the wholesale price. So Namrata, no. First of all, we said that in case of short selling, in cash market, it is not allowed. You cannot short sell only. Even if you short sell, there are principles, there will be penalties. What will happen to you? Stock exchange will buy from your end and whatever price it buys, it will give it to honor the contract for the short selling purposes. And you must know what is the reason of not allowing short selling in cash market, because you cannot sell what you don't have. Because the moment you sell it, you need to give it for the delivery purposes. The shared certificates you have to give for the delivery purposes, which you don't have. Correct. So hence short selling is not allowed in the cash market, and hence there is no portion of settlement that arises here. And you will not receive anything. However, short selling is allowed in F&O market, which is futures. And the moment you enter in futures, still you get nothing, because on settlement, only the net payoffs happens. Nothing happens on gross basis. On settlement, only net payoff will happen. Okay, Namrata. So you will never get the entire sale price the moment you short sell. You will never get that. Okay. Because as I explained in cash market, it is not allowed. F&O market, nothing you will have to pay or receive on the time at the time of entering the contract. Whatever settlement happens, it happens after the expiry of the particular contract. Okay. Now, what are the uses of these derivatives? Valuation is done. All the other things are done. Now, students, first use. So, primary, there are two uses. One is speculation, and second one is hedging. Now, what is speculation? Speculation is hope of gain against a risk of loss. So, speculation is one-sided exposure in the anticipation that you will gain, and there is an anticipation that you might lose also. Okay. For example, you have taken a long position in futures. Now, I hope all of us are comfortable with the term of long position and short position. Long position is if I have bought something. Short position if I have sold something. I have taken a long position in futures of X limited 80 into 1000, that is 80,000. And there is a margin requirement. So in all the stock exchanges for dealing in futures and options, they ask us to keep some margin, which is around 20% of the value, which is let's say 16,000. Okay. So 16,000 we have ended up giving as a margin. Now what happens? Let's say the actual price comes as 70. So 70 minus 80, 80 is what we have taken as a long position. So there is a loss of 10,000 because the moment you take long position and the prices comes down, you will bear loss because you have a contract to purchase something at 80 rupees, but in market that value itself has come down to 70 rupees. So don't you think that this is not a contractual right anymore? This is a contractual obligation. This is a contractual loss. Okay. So there is a 10,000 loss here. Then you will get 16,000 back. Net, you will get 6,000 back because 16,000 is just a deposit. The margin is just a deposit. Similarly, if the prices goes to 90, then 90 minus 80. Now understand it like this. I have a contract to buy a future at 80 rupees, but the market is having a price at 90 rupees. So don't you think I have a contractual right? I have a contractual gain because in the market, that particular future is trading at 90 rupees. And hence, I will end up earning 10,000. 16,000 I will get back of my deposit, and hence entire 26,000 I will get it back. So this is a cash flow. Now, Kaushik is saying, I understand short sell as we already have shares and expected price go down. So I sell now, repurchase later at lower price, and this is not allowed. This is okay, Kaushiki. But essentially, this is not short selling. Short selling is something that you don't have and then you are selling. But as legally, what you are saying, Kaushiki, this is right. You can do that. Okay. Because you have mentioned that you already have shares and hence you are selling the already held shares. That is allowed in the cash market. Namrata, we have to pay margin at the time of entering into the contract. Yes, we have to pay. And both the parties pay the deposit. Yes. Okay. Now, so this is what? This is speculation. You have taken a long position. You have speculated that the prices will go up. Correct? That the prices will go up. Hence, you have entered into a long position. Correct. But in case the prices goes down, then you have also suffered a loss of 10,000. The prices has gone up. In case you will enjoy a gain of 10,000. Correct. So as I said, that speculation can have both the sides. Now come to the short position. Short position in futures means that I am selling future now. I am selling future. Selling future means I am entering into a contract to sell equity share of that underlying, which is X Limited, after the expiry of whatever tenure this future have. So I have sold this future at 80 and hence, sorry. Okay. I have sold this as 80,000 contracts, 80,000. Again, deposits I will keep 20%. Now, what if on expiry, the price goes down? If the price goes down in short selling, I always get a benefit. Why? Because 80 is what I was supposed to sell. 70 is the market that I would be selling if I get. But since I have a contract to sell at 80, so that contract is beneficial for me, correct? I will get 10 rupees more. And hence there is a gain. However, the prices goes up. In case you have short sold, then you will lose. Because in the market, you could have sold it at 90. What is the point of having this contract which is giving you a selling price of 80? You will lose 10 rupees here. Hence, there is a 10,000 loss here. Okay. Namrata is saying initial investment is lower as compared to the cash market. Yes. Initial investment is only to the extent of the margins that we have. Students, again, I'm saying, please note that these are only the revisionary aspects that we are discussing. Okay. These are not in detail discussions, although I'm trying to go as much as detail wherever there are some concerns or wherever there are some queries, correct? But for detailed understanding, I request please go through the lectures. This is just to revise and to solve any incremental queries that all of you might have, okay? Because all of these things we have covered. Initial investment is lower than compared to the cash segment, okay? Now hedging. So speculation is clear. Speculation, we will enter either into a long position or into a short position. Long position, we will always enter when we have an anticipation that the prices will go up. Short position, we will enter only if we are anticipating that the prices will go down, correct? And in case the reverse happens, we'll end up losing. Okay, students? Now comes the hedging part. So till now we have discussed about speculation. Speculation is clear. Speculation is to speculate whether the prices will go up or go down. Hedging is protection. Protection from what? You are already having or exposed to a risk. Already you have a risk. And hedging means you are protecting yourself against that risk. For example, you are already holding an equity share of X Limited in the spot market. Okay, and you are holding it at 100 rupees. So if the 100 rupees goes up, you will gain. But the moment 100 rupees goes down, you will lose. So gain part is okay, but loss part is not okay. So this is a risk. If it goes down, it is a risk. So that risk that it might go down, this is a risk, correct? Now, to curb this risk, what action you will take? In case it goes down, you will have to devise a technique that when the price goes down, you gain. That is available through short selling futures on X Limited. If you do that, the moment price goes down, you will gain simply. So you go to the futures market and you assess that your risk currently holding X limited equity share is that prices might go down. So you devise a technique where I gain in case that the prices goes down. What you will do, futures market, what shall we do so that only price reduction gives us gain? We will take a short position. Simple. Now let us try to understand through this example. 100 shares we have purchased at 300 rupees per share. There is a risk of prices going down. So what you do simultaneously, 100 futures you sell in the derivatives market at 350 per share. Definitely the price will not be same as the spot market because derivative has the time value of money adjustment in this. Correct. As we discussed in the valuation. So 300 would become 350 and hence you have hedged yourself for the downward risks. You have protected yourself for the risk of downwards by entering into a sell futures. Now, we have taken 3 examples. Let's say the closing price becomes 300, 350 or 400. We have taken 3 cases. In case the closing price is 300 itself, since you have purchased 100 shares at 300, the initial payoff will be 30,000 rupees each. Correct? 300 into 100. Then margins of short selling the future will also be how much? You have short sold future 350, 100 futures you have short sold at the rate of 20%, 777,000 you will end up paying. So this is your initial outflow, which will be same in all the cases. Now on settlement, what happens? On settlement, the closing price of the share itself becomes 300, 350 and 400. So in the first case, you will realize 30,000. This is for selling the X limited equity share in the spot market, I'm saying. Second case, you will realize 350 into 100. Fourth case, you will realize 400 into 100. So you will realize this much. Plus whatever margin you have given, you will get it back. And you will have to pay the settlement on futures, which will be calculated how? 350 is the strike price, or let's say 350 is the price at which we have entered. In case 1, the price has gone down to 300 from 350. What do you think? You will gain because you have short sold the future at 350. The price in the spot market has come down to 300. So 50 rupees on 100 futures you will gain, which is a 5,000 gain. Correct? In the second case, the price has become same, no gain, no loss. In the third case, you have short sold as 350. The prices has gone up to 400. You will lose 50 rupees on 100 derivatives. So there is a loss of 5,000 rupees. I hope this is clear why this will be a loss. Because you have entered into a selling futures at 350. The price on the expiry has gone to 400. You have entered into a contract to sell something at 350 for which the actual market price is 400. You have lost 50 rupees because if you have not entered into this contract, you would have sold it in the open market at 400. That means 50 rupees is the loss because of this contract. So the cash flows will always be 42, 42, 42. This is what the hedging is. So because of this hedging, you have earned 5,000 rupees bare minimum. Because 42,000 in all the scenarios and 37,000 is your initial outflow in all the scenarios. So 5,000 is what you have got. So if you buy equity, sell futures on that equity, this 50 rupees difference is there, which is what your 5,000 rupees coming from here also. This is what we have tried to correlate here. So in a nutshell, hedging, you're already exposed to one risk. and you hedge against that other risk. Speculation, there is no existing risk. You create that risk. You create that risk through speculation. Correct. So these are the two uses of forwards and futures till now. Now again, through this chart, this is another way to understand long position and short position. Derivatives is a contract. Contract to buy on expiry. This is what a long position is. Contract to sell on expiry. This is what a short position is. Futures price, it keeps on changing. And it is exposed to a risk of downside. Here it is exposed to a risk of upside. Okay. As I said that if you take a long position, you are definitely exposed to a risk of downside. Because if your underlying goes up, your derivative will also go up. And if you have taken a long position, you will always get a benefit there. However, in case of a short position, if your underlying goes down, hence your derivative will also go down, then also you will gain. But the situation happen vice versa, then it will be a concern. So Kaushik is asking, please explain the result again. I think you're asking for this part, right? So the result part, we said that, I hope this settlement is clear, correct? Because settlement will happen for two things. One is the underlying and one is the futures. So for the underlying, you will get a sale proceeds equivalent to 300, 350 and 400 in all the three cases. You will get your margin back and you will end up settling your futures. Now, how settlement will happen on futures? You have short sold your futures. While you have short sold your futures at 350, if the prices comes down, you will gain. If the prices goes up, you will lose. Correct? Since in this case, the prices has come down, you have gained 5,000 rupees. In this, the prices has remained same, 350, 350, nothing has happened. And in this case, the prices has increased from 350 to 400 and hence you have lost. Now, this is the result. The result says 42,000 is your inflow. This is your outflow. Net, you have earned 5,000 of gain. And how we have derived this 5,000 of gain? In the spot market, we have purchased an equity share at the rate of 300. In the futures market, we have short sold futures at 350. What is the meaning of short selling futures? Short selling futures means on the expiry, I am going to sell the underlying at 350. Although I don't sell actually the underlying, I only receive the net amount, which is, let's say, this 5,000 or this 5,000, correct? I don't actually sell it. But the net settlement will have the same impact. The net settlement will have the same impact of this 50 rupees. Because ultimately, I am contracting to sell something at 350, which I have purchased at 300. So 50 into 100, which is 5,000. Okay, Kaushiki, I hope this explains. And hence, this 50 into 100, 5,000 is equal to this 5,000, which is the hedging gain. Janvi saying, can the profit be more than 5,000? So Janvi, in this example, it cannot be because you have already hedged yourself by entering into a 350 rupees selling futures. Had you have entered into 370, the profit would have been 70,000. Correct. So, but again, it depends. If you have already entered and fixed your selling price at 350, that means it will not be more than 5,000. So that is what the limitation of hedging is. See, hedging is not done to earn unlimited profit, or it is not done, or it is done to avoid the unlimited losses, is what I can say. Hedging is done to avoid the unlimited losses, but speculation is one-sided, right? You can have unlimited profits, you can have unlimited losses also. Hedging, you will have limited losses or limited profits depending on the prices that you have entered. Okay. Namrita is saying 7,000. Sorry, sorry, this is 7,000. It's not 70. I've spoke 70, but it's 7. Yeah. Okay. Then we came to the arbitrage. So arbitrage is called as riskless profit. This was arbitrage. If you saw, okay, let's understand from this. This question itself said that you have to calculate the theoretical minimum price. For example, basis the future value and present value, the price comes as 1908. The actual value is 1950 of that particular future. Okay. So don't you think it is overpriced? And what we do with something that is overpriced, we discussed in our previous revisionary session also on portfolio. Whenever something is overpriced, we always sell it. So selling futures means that you have to buy share in the spot market, buy share and sell the overpriced instrument. So what we have done is, for buying a share of 1800 rupees, we have taken a loan. Initial net cash flow is nil. Then we will hold one share and we will sell in this. Okay. Now what will happen to the cash flows after 6 months? So you leave this box. Let's first focus here. After 6 months, we will sell and realize. We will sell and realize at the rate of 1950. Just like in my previous example, our selling price was fixed at 350, correct? And in this case, if we have sell futures at 1950, we will realize 1950 in all the scenarios, whatever the scenario is. And then we will end up repaying our loan 1800 plus the rate of interest on that 1800, which is 1908. So this 42 rupees is the riskless profit. This is called as cash and carry arbitrage. Friends, we have covered these things very much in detail in our detailed sessions. Okay, this is called as cash and carry arbitrage. So arbitrage is something which is taking an advantage of the futures market. In this particular context, I'm saying futures market and interest rates. See, in an ideal world, the future should have also been at 1908 only. There is no reason why it would be at 1950. But since it is at 1950, to get a 42 rupees benefit, we have entered into this kind of a technique. Okay. And why? So the question will come that why are we devising buying a share here? Why? Because we have already fixed that we have to sell the futures because it is overpriced. Hence, to take a opposite position, we have to buy a share in the spot market. Correct? Because then only the hedging will be happening. Hedging is taking an opposite position in the other market. Okay. Now, there can be a situation where, so this is the situation we have discussed. Forward is overpriced. We will short sell forward. We will borrow money and buy one spot asset. Correct. Now, there is another situation. In this case, I have assumed, or let's say the question itself would have asked us to assume that in case it is becoming as 1850. I don't know, it's not there, but let's take this example also. In this case, the theoretical minimum price is 1908. This is 1850. Hence, it is underpriced. Now, if the future is underpriced, you will long future or you will buy future. Now, if you're buying future in the derivative market, you will have to sell equity share in the spot market. Selling equity share in the spot market will mean short selling, which is not allowed. So what you are going to do, you will borrow an equity share and then you will short sell. Okay. And then whatever you get proceeds, you will lend that money at R percentage. And in this case also, you will be getting a 58 rupees of riskless profit. This is called as reverse cash and carry. Okay. So we have again discussed the hedging through some other angles. For example, X Limited is an equity share and there is a future on X Limited also. So we can do the hedging. Yes, we can do the hedging. Another principle we can hedge equity of X Limited is by the index, the futures on this index. And how we can do that? We know that X Limited's equity share is related to this index through a factor called as beta. This we have studied in our portfolio also. So X Limited is related to index through beta 1.2 or 0.8. So if it is 1.2, it means that if market moves by 1%, X Limited will move by 1.2 times. 0.8 will mean that it will move by 0.8 times. So if it is the same stock, which is this case, what you will do, cash and derivative, there are two markets, right? Cash market and derivative, you take equal and opposite exposure position. You always take equal and opposite. So if you buy here, you will sell here. If you sell here, you will buy here. So this is the opposite position, and equal means if you buy one share, you will sell one for derivative. If you sell one share, you will buy one derivative. Okay. But if it happens through market index, then what you need to do is beta minus required beta multiplied by value of share. So this much amount you will have to take a position in the derivatives market. So this required beta can sometimes be zero also. If the question is not specifying, then always you take required beta as zero. But if question says that your existing beta is 2, you need to do a hedging in such a way that your required beta drops to 0.5. Then you just take this equation 2 minus 0.5. And so this answers that how much to be taken, correct? Through market index, how much to be taken, and whether opposite or same position we have to take will be given. If beta is positive, then you take the opposite position. But if beta is negative, then you take the same position. If you're longing here, you also long here. This is cash market, this is derivatives market. If you're shorting here, you also need to short here. But in this case, if you are longing here, you have to short here. If you're shorting here, you have to long here. So students, please note that this entire discussion on this hedging is very useful in some of the questions. Okay. So that's why I have tried to put it separately so that we understand the concepts and then we will jump to the questions. Okay. Sorry. So students, it's 8:35 now. Let's take a 10 minutes break and we will again reconvene at 8:45 to discuss and to revise the further topics. Welcome back, students. Let's carry on with our next discussion topics. So these were again the questions that I am skipping as of now, that we have already covered in the detailed sessions. Just going through them, if there is something specific that we have discussed as a concept between these portions itself, we can do. See, for this is the application of that beta minus required beta for calculating the number of contracts, right? Question number 11. I'm just glancing through if there is something, otherwise we will jump to our next topic. Yes. Let's come to options. Now we will focus our discussion on options. So till now, students, we have covered futures and forwards as two types of derivatives, their valuation principles, their uses as speculation and hedging. Now let's come to options. So students, options, please pay attention. So we have discussed first about call option. In case of call option, we said that let's try to understand from this flowchart. So A again is a financial instrument that we said, which is a contract, right, option, whatever you want to say. So A here we are designating as a right or option, but this is not an obligation. Okay. And this is not a mandate also. And what is this right for? Right to buy. Please emphasize on this. Right to buy an underlying asset. It can be anything. Underlying asset can be anything at a specified price, which is a strike price. So please pay attention. The terms that we are using here are some of the technical terms that would be used in the different things. So strike price is there, and it says that it will be exercisable on an agreed date or up to an agreed date. Okay. So in the starting part of the session, I said that expiry we will discuss in detail at the time of options. So there are two kinds of expiry in options. One is up to an agreed date, up to any time up to that agreed date, or only on an agreed date. Okay, so there are two kinds of settlements that are available. Okay. Then put option also, again, we said that put option is a right obligation. Sorry, it's a right and option, but not an obligation and not a mandate, but to sell. Here, the differentiating factor is that it's a right to purchase and it is a right to sell the underlying asset, again, at an agreed price, on an agreed date, or up to an agreed date. Okay, students. So that agreement to sell, the contract to sell an underlying is called as an put option. The contract or the agreement to buy is called as a call option. Let's say tenure is 3 months of these options. So today is 0 day, 1 month, 2 month, and 3 months. And today we are entering into a contract. And now let's restrict our discussion of the contracts as options, right? Let's not go back to forwards and futures. So we said that there are two modes of settlement: on an agreed date or up to an agreed date. So first of all, let's try to understand what is an up to an agreed date. Up to an agreed date means that this option can be exercised at any time up to 3 months. At any time up to 3 months. This is called as an American option. Anytime up to 3 months. This gives you a flexibility not only to be exercised at a particular date, but up to that particular date. And if there is, the option says that only on the expiry you will be able to exercise, not any time before expiry, then it is called as a European option. Okay. I hope the difference is clear between the American and European. So the European options gives you the exercising only on the expiry date. American gives you the exercising of the option at any time up to the expiry. Okay, this is the clear difference. Now, students, whenever we are talking about options, please always keep in mind we are talking about the rights. Okay, we are always talking about the rights. We are not talking about the underlying. We're talking about the rights. Rights of what? Rights to buy or right to sell. Right to buy is call option. Right to sell is put option. Okay. Now, linking back to this, there are parties to the option, correct? There are parties to the option, which we have already seen in the standard features of derivatives also that we discussed. There are parties to a derivatives, whether it is forward, future, or whether it is an option. So we said that right to buy is called as call, right to sell is called as put. Now let's try to understand the parties for a right to buy. So the parties for right to buy, okay, so the parties for right to buy will be, first of all, there is a buyer of this right and there is a seller of this right. And please don't confuse it with the buyer of the underlying or seller of the underlying. Please don't confuse it. Those again can be different parties. So for this option, for this right, for this call option, which is a right to buy, there is a buyer of this right and there is a seller of this right. And on expiration or up to expiration, American option, on expiration, European option. It depends. It can be both, right? As we discussed. Once we exercise this right to buy, the buyer of right to buy becomes the buyer of underlying because he or she has agreed to buy the underlying. That means on exercise, he or she will become the buyer of the underlying itself. And he or she will become the seller, will become the seller of the underlying itself on the exercise of the options. That is called as right to buy. Okay, students, any query in this or any other things? Then we will move forward. So the point that we're trying to make here is that we're talking about the parties to the right are essentially not the same parties who are the buyer of the underlying or the seller of the underlying. In the right to buy, the buyer of the right will become the buyer of underlying on the exercise of the option, and the seller of the right will become the seller of the underlying on the exercise of the option. Let's come on the right to sell, which is the put option. So there is a buyer of right to sell, there is a seller of right to sell. Okay. Buyer of right to sell the underlying. So I will become the seller of the underlying. Okay. And in this case, the seller of right to sell will become the buyer of underlying. Kaushik is saying not clear. Okay, let me explain. Again. So I think call option was relatively easier to understand. But put option, first of all, think it that put option is a right to sell. This is the contract, right to sell. If I'm purchasing a right to sell, that means on expiry, I will be selling the underlying. Correct, because I've purchased the right to sell. If I'm selling the right to sell, On expiry, I will have to purchase the underlying. Correct. So this is what we have mentioned here. Buyer of the right is also called as holder of the option. Seller of the right is also called as writer of the option because seller writes the option. Okay. I hope this understanding or this discussion is clear, Kaushiki. So please understand, if I am purchasing a right to sell, I will ultimately sell the underlying, correct? As of now, I am purchasing. As of now, I am a buyer of put option. But it essentially not means that I will buy the underlying also when the expiry comes. I will be selling the underlying because I've purchased the right to sell. If I would have purchased the right to purchase, which is the call option, then I would have purchased the underlying also on expiry. Okay. Now, Mr. A and Miss B. Mr. A is the holder, Miss B is the writer. So Mr. A pays premium to Miss B, and Miss B will sell the right to buy to Mr. A. Okay. And this is happening at what? Strike price is 110. So right to buy at 110 with a spot price of 100. Time is equal to 3 months, and we are saying that it is only to be exercised on the expiry, and X limited is the underlying. Now let's understand. Call option, right to buy X limited share after 3 months at the rate of 110 per share. This is the contract. Correct? This is the contract. Right to buy X limited share after 3 months at 110 per share. This is what the terms are. These terms have been put in a normal statement. So Mr. A will pay premium to Miss B because Miss B is giving a right. If someone is giving a right to someone, the person needs to be compensated for giving the right. That compensation goes in the form of premium. So this 10 rupees is paid as a premium for compensating towards the right. Now on expiry, let's discuss what will happen on expiry. Let's say spot price on expiry becomes 125, 95 and 110. We have taken 3 examples. One higher, one lower and one same. Now students, please understand and please think along with me. If on expiry, the price becomes 125, Mr. A is holding a right to purchase at 110 for a security X limited for which the open market price on expiry has become 125. Don't you think Mr. A says that this option is in the money for me? In the money means it is beneficial, because I will be able to save 15 rupees if I execute this contract. I will be able to save 15 rupees if I execute the contract. So hence it becomes in the money option. So Mr. A will become happy. Correct? Similarly, at 95 rupees. Now let's again formulate the statement. Mr. A has a right to purchase X limited at 110 rupees for a X limited share which is available in the open market at 95. Do you think X limited will exercise this right? No. Because Mr. A will go in the open market and purchase at 95. So this right need not be exercised, and this is not a right anymore. So this is called as out of the money. It will, he or she will not exercise the same. If the price is 110 itself, then it is called as at the money. Holder is neutral to exercise. Whether I exercise or not, I am neutral to it. Okay. Now the difference between this and future also, let me briefly touch upon. In futures or in forwards, I will end up having a loss of 15 rupees here in the same situation. But in this case, I am avoiding this loss because I have a right. I don't have an obligation. In futures or forward, I have an obligation to purchase at 110. Here I have a right. I hope all of you understand the difference between rights and obligations. So in futures, whatever is the price, I will have to purchase at 110. In options, I have an option to purchase. If it is beneficial for me, I will purchase. If it is not beneficial for me, I will skip it. Okay. Now gross settlement. In case of gross settlement, in the case 1, in this case, what will happen? I will pay 110 and receive 1 share. In this, nothing will happen. In this, nothing will happen because I am not exercising. In case of net settlement, I will receive 15. In case of net settlement, I will receive 15. Why? Because 125 minus 110. In this, I don't have to pay anything. No need to pay. Why? Because I have an option. I'm not exercising it. I've already paid you premium of 10 rupees to compensate you earlier while I entered into the contract. So that is what Mr. A will say. Similarly, here nothing needs to be done. So what is the net gain or loss? So 15 minus 10 is the premium. So from Mr. A's standpoint, 15 rupees is the gain on the instrument, 10 rupees is the cost of entering into the instrument, 5 rupees is the net gain. Here 10 rupees is the loss, 10 rupees. So this premium is actually your cost, but you are not getting anything in return for that in case 2 and case 3. I hope this is clear. Now, from Miss B's angle, Mr. A's loss is Miss B's gain, and Mr. A's gain is Miss B's loss. Same. So here it is a loss of 5, gain of 10, and gain of 10. So this is from Miss B's angle. Okay. Now, loss to the writer is always unlimited. Gain to holder is also unlimited. But gain to writer is always limited maximum up to the premium. And loss to the holder is also limited maximum to the premium, because the maximum that I will lose is only the premium worth of amount. Okay, students. I hope this basic understanding of options is clear. So it is just like an insurance. So what happens in an insurance contract? For insurance, the insured gives a premium to the insurance company. In case any loss happens, that loss will be passed on to the insurance company, and hence the loss to the writer, the loss to the insurance company is unlimited. But the gain to the writer, which is the gain to the insurance company, is only limited up to the premium. I hope this is clear, students. Now let's take an example of put option. So put option, strike price is, let's say, 110, spot price is 100, and time is for 3 months. Mr. A is actually the holder of the right to sell. Mr. A is holding the right to sell. Miss B have written or have sold the right to sell. Correct. From our previous parties discussion in the options, we discussed this. So what will happen on expiry? Let's say on expiry, the price become 95, 110 and 125. This 100 also we have taken an example. So let's say there are 4 cases. So from the point of view of Mr. A is holding the right to sell something which is X limited at 110, for which the market price has gone down to 95. So don't you think Mr. A is happy because Mr. A can sell that X limited and 15 rupees higher than what market is offering. So it is in the money. In the money, it is beneficial to the holder. He will exercise the option. In case it is 110, it is called as at the money, which is neutral. In case it is 125, what will Mr. A say? In outside market, I will be able to sell the asset at 125, but I have a right to sell the asset at 110. Do you think it is a right anymore? No, it is not at all a right. It is just a loss. So it is out of the money. It is unfavorable to exercise this. So Mr. A will not exercise this because Mr. A has an option of exercising or not exercising. So Mr. A will not exercise this. Then how the settlement will happen? We have discussed 2 cases. If it happens on gross basis, if it happens on net basis. If it happens on gross basis, Mr. A will transfer the shares and he will receive 110. In this case, nothing will happen, and in this case also nothing will happen. In case of net settlement, Mr. A will receive 15 and here also nothing will happen. So net gain or loss, 15 minus 10, minus 10 minus 10, which is premium. Again, Miss B's angle, the same criteria that we have understood. Okay. So what we can imply from this? We can imply one thing: holder of call option and holder of put option. Holder of call option, better if price goes up and beyond the strike price, then only it is in the money. And the holder's perspective, put option will be better if the price goes down below the strike price. This is also in the money. Correct? Because if the price is actually going above the strike price in case of a put option, it will be a loss. It will not be a loss per se, but it's not a favorable situation. Correct? Because loss can be avoided by Mr. A by not entering into that particular contract. Now let's compare both options and futures. Options also have underlying, futures also have underlying. Options also have time limit, futures also have a time limit. But options is a right. Futures is a mandate. Options always will give holder only gain subject to premium. Only premium is the cost. But here either gain or loss will come. Okay. Yes. So here the premium is the price of the contract. The price or the value of the contract is premium itself. For future, it is the future price. That is the value. Now let's discuss the payoffs. It is very simple. Let's say we are saying that the strike price is 40, premium is 5. So in case of a call option for buyer, holder, or someone who is longing the call, we can call this as someone who is taking a long on the call option. He is also the holder. He is also the buyer. Similarly, someone who is writing the option is taking a short position. Okay, so we will discuss that also. So the payoffs. So here we have mentioned on the y-axis payoff, x-axis is price. So loss is limited and gain is unlimited. So up to 45, the loss is limited and eventually the gain will become unlimited. If the price keeps on increasing beyond the strike price, the gain to this holder will also increase. Now, this is a call seller who is shorting the call, who is writing the call. So the gain is limited. This 5 rupees gain is limited, correct? But the loss will be unlimited. So anything, it will go down. So this is a higher loss. That's what we discussed. Loss to the call seller in case the price goes beyond and above the strike price. Okay, students? Let's come to put option, which is the right to sell. So someone who is a holder or who has long the put or who is a put buyer, from his or her side, the strike price is 40 and premium is 5. So as the prices goes down, the gain will increase. Correct? As the price is coming down, the gain is increasing. So loss is limited and gain is unlimited. Similarly, from the put option seller perspective or the one who is doing the short selling of put. Short selling means I am selling it. So don't confuse it, the short selling that we discussed earlier. Short means I'm shorting it. That means I'm selling it. That means I am a put option writer. I'm a put option seller. So in this case, gain is limited, but loss is unlimited. As the prices keeps on coming down, the writer, the seller of put option will bear unlimited losses. Okay, students, I think the payoffs are clear. Any questions till now, or shall we move forward with our discussion? Kaushiki, Namrata, Anandi, and Viraj. These 4 names have come here, so I am asking specifically, and anyone else also who has joined, please do let me know. Till now it is clear so that we can move forward. Okay, Kaushik is saying okay. So forwards, futures and options. Options, till now we have covered what is the concept. 2 types of options: call option, put option. Call option, right to buy; put option, right to sell. We have also discussed that how the settlement happens between both. To explain in the stock market how it happens. For equity, there is a buyer and seller and there is a price. So the spot market. For stock exchange, which are futures, there is a buyer and seller and there is a future price against which the deal happens. For options, buyer and seller are there, but the price is premium. The price of the option is the premium that we paid. And ultimately what happens? If I buy an option at a premium of 10 and if I sell that option tomorrow at 12, I get a gain of 2 rupees because I have entered into the different buying and selling position for the same contract, for the same option at different prices. Okay. Correct. Now let's try to understand this. So logically, students, if you see what is the value, or let's say what is the price of the particular option. For call option, the expected price minus strike price. Strike price is what is specified in the contract. Expected price is what we are expecting the price of the underlying to be on the maturity. Let's say we expect it as 120. 110 is the strike price. So 10 is the ultimate value of that contract. Correct? Because if it is a call option, If it is a call option, then 10 is the ultimate value. So how will premium be determined? Premium will become the present value of this 10 rupees. Similarly, in case of a put option, the strike price of 110 and expected price of 90. Correct. So that 20 rupees becomes the in the money of the option is 20 rupees. So that present valued will become the value of that particular option. Sorry. 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 So then let's come to the different valuation techniques that are there for the options valuation. So first technique is binomial model. Binomial model always assumes that only two possibilities are there. Bi means two, bi means two. One is the upper price or second is the lower price. We are standing on 0 day. The price can go up to 33 or it can come down to 27. So that means plus 10% minus 10%. And we have to find out the probabilities. What is the probability that the price will move to 33? What is the probability that the price will move to 27? There are two ways to calculate the probability. One is this formula, which is 1 plus r minus d divided by u minus d, which we said that r is the rate of interest, d is the proportion which we have reduced, and u is the proportion that we have increased. So 27 by 30 becomes 0.90 and 33 by 30 becomes 1.10. Correct. And if it is a case of continuous compounding, 1 plus r gets substituted by e raised to the power rt, that we already know because of the continuous compounding. So if we solve this, we get to know that what is the probability of prices going up. So the probability of prices going up, solving this becomes as 62.5, and hence the probability of price going down will become 37.5. So here it is 62.5, here it is 37.5. So binomial model says that first of all, you prepare all the different possibilities for the price to go in the future. So one possibility is 33 and 27, and accordingly you calculate the payoffs at every node. The payoffs at this node will be 33 minus 28. Strike price is how much? Strike price is 28. So 33, this is a call option. 33 is the expected price. 28 is the strike price. 5 rupees will be the gain at this node. Here loss will be 0. Because 27 minus 28, the option is out of the money. The loss will become 0. This 5 rupees you multiply with the probability that we have calculated and you will arrive at some of the amount. You take a again similar exercise here on the second node, total this and take a present value of this. You will be able to arrive at the premium of that particular option. I hope students it is clear. Then there is another method to calculate the probability, which is called as risk neutral method. So what we understand is that the 30 rupees, which is the current price, if we multiply the two possibilities with the respective probabilities. So probability 1 is 33, it will happen, and 27 is 1 minus p. Correct? Because always both the probabilities will have summation of 1. If we divided it by the present value factor, we will arrive at the present value at 30 rupees. So 30 into 1 plus 2.5%. So this will also give us the probability as 62.5. So probability to become 33, 62.5, and probability to become 27 price is the 37.5%. So value of the option will be present value of probability adjusted payoffs. which is 3.125 divided by the present value factor. So this will give us so this is what the binomial model is. So binomial model says that, first of all, you try to plot what are the different possibilities. There are two possibilities. And for each of the possibilities, you calculate the probability. Probability, there are two ways to calculate. One is the formula that we have discussed, and second is the risk neutral method. Once you arrive that, you calculate the payoffs. Payoffs you multiply at each node. And at every node, you multiply that payoffs with the probability to arrive at the probability adjusted payoffs. And then you simply take the present value of that to arrive at the value or to arrive at the premium. Okay, students. So we did numerous questions. Now, in this question, even the multiple nodes were possible. A will go to B or A will go to C. Then from B, it will go to D, and B, it will go to E. So like this, there are from one node, two nodes, then another two nodes, four nodes. Like that, there are different nodes possible. That is given in the question, that till what extent and till what nodes you will have to go. For example, in year one, there are two possibilities. And then in year two, from those two possibilities, there are another two possibilities. Correct? So likewise, we have calculated for each node what is the payoff and what is the probability. Correct? And we discussed that binomial model is actually useful for both European and American options. European, we will always take only two nodes, B and C, that is on expiry. For American options, we will take multiple nodes because it can be exercised anytime before the expiry also. I'm just going now to, yes. Now let's come to 4 techniques. Okay, as of now, you ignore what is mentioned in the red color here. We will cover that towards the last part of the session. Let's say you are taking a long position on call option. That means you are purchasing the right to buy. The moment you do that, you have to invest the present value of strike price today, because on the expiry of the contract, you have to pay that strike price equivalent amount to purchase that particular underlying. So you have to invest the present value of strike price today. So just remember this sequence. The second sequence, if you are taking a short call, if you're doing a short of call option, then you are selling the right to buy. That means you have to purchase the equity share today so that on maturity, when the holder exercises the option to buy, you are able to produce your security or your share. Correct? So that the transaction can be completed. Third case, you have to, let's say you have taken a long position in put option. That means the right to sell you have purchased. If you have purchased the right to sell on the expiry, you will end up selling that share. That means you have to purchase share today and keep it with you so that on expiry, you will be able to honor your contract. If you have short sold your put option, that means you have sold the right to sell. In case the option holder on expiry executes this right to sell, that means you will have to purchase the share, and you will be purchasing the share at the present value of the strike price, which is this amount. Okay, students. So just remember these 4 sequences. We also discussed American can be exercised up to expiry and European only on the expiry. So options have buyer and seller against this premium. Correct? Now let's say day 1, the premium is 8 rupees. Day 2, it has gone up to 10 rupees. So the buyer will gain 2 rupees, seller will lose 2 rupees because the option price has increased. Correct? So what statement we have put here? Option premium is always reflective of the extent to which it is in the money adjusted for the time value of money. This is very simple, students, right? So options will always reflect the extent to which it is in the money and which is adjusted for time value of money. Because ultimately, as a seller of the option, I will demand what I am supposed to pay on maturity. On maturity, I'm supposed to pay whatever is in the money amount, correct? For that, only I will ask you to pay me the premium. At least that amount I will ask as a premium. Correct, students? Now, for example, day one, we expected that spot price will be 100. It becomes 20. Now, day two, suddenly the expectation becomes that the spot price will become 150 on the date of expiration. So the option will also become 70, which is the higher premium. So the option movement will also be by another 50 rupees, adjusted for time value money, of course. Okay. Student, just give me a moment. Yeah. So we can resume. So this 50 rupees, as I was telling, the premium will also become higher. Reason being, the spot price has moved in that direction. And this I'm talking about the call option. If it is a put option, the value will become zero. Why? Because the spot price has increased. The moment spot price is increased, in case of a put option, it becomes out of the money. Correct? So this statement is very true that whatever is in the money in that option, that is actually giving you the premium base, premium amount calculation basis. Okay. Yes. Now there is something called as perfect hedge. So the formula to what is, first of all, perfect hedge? Perfect hedge is, if you see that till now we have been assuming that one future will be used to hedge one share. That is what we have discussed. But in case of options or in case of even futures also, practically that equation is not true. It might be possible for one option, you only have to take a position of 0.5 shares or 1.5 shares. So that is called as hedge ratio. Hedge ratio is something for an underlying, how much underlying you should take for taking one financial instrument or vice versa also. for one underlying, how much options or futures quantity you should take. Okay. So perfect hedge is something where you have actually devised the underlying and the financial instrument or the derivative in a similar ratio, which is given by the hedging ratio. Correct. So let's say if your hedging ratio denotes that 0.5 shares for one option. So if you devise this hedge, this is called as a perfect hedge. If you go with what hedging ratio is telling you and you enter into that hedging relationship, that is called as a perfect hedge. The way to calculate this is payoff at higher price, payoff at lower price divided by higher minus lower price. If you do that, this will give you the hedge ratio. So how many shares to be traded for one option? 0.5 shares to be traded for one option. The investor should purchase 0.5 share for every call option. This is called as hedge ratio. Okay, students? I hope this is clear. So this is another interesting concept. Let's say as an investor, you have purchased 0.5 shares and you have written a call option of one. One option you have written as a call. Yeah. And since you have written a call option, the strike price will be 225 in that case, for example. So the premium will be how it will be calculated. Cost paid for 0.5 share, which is 500 into 0.5 minus income I'm writing on one call, which is premium you will get. It should be equal to 225 divided by 1 plus R, present value of cash flows. So this 225 is again continuing from that example, and this is just proving those premiums calculation. Now let's come to the second last important topic. After Black-Scholes, we will also cover the put call parity theory, and then we will wrap up. Now, students, all of you, please pay attention, because this is something that we will discuss, and we will discuss step by step to make the cases here and understand it. Okay. So Black-Scholes model, students. This is a model to value, or let's say to calculate the price or the premium of a particular option. So let's take a situation. I think this is case 2 we have come to. Just a second. Yes. Okay. So under Black-Scholes model, let's take this example. So the 4 cases that I've told now, 1, 2, 3, 4. Out of that, I am taking the second case, where Mr. A has already purchased the shares, and Mr. X has purchased the shares, which is I am treating this as A, and B is Mr. X has also short sold the call option. That means he's the writer of the call option. That means he's selling the right to buy. We're talking about the call option first. Okay. So for purchasing the share, there is a cash outflow that will happen today. Yes. And there will be a cash inflow equivalent to the strike price that will happen on the expiry of the contract. Correct? Because I'm selling the right to buy. In case this gets exercised, the right to buy, I will get a cash inflow and I will give that share to them. So if I do A minus B, A is the share currently and B is the short selling, I will get the premium, correct? Which is cash inflow and cash outflow. So A is my cash outflow and B is my cash inflow. Whatever it is, I will expect at least this much of amount as a premium, correct? Because ultimately I will be earning, I should earn at least this much from Mr. X point of view. So cash outflow is happening today and inflow will happen after 3 months. So I cannot simply say A minus B. I have to say A minus present value of B. That is the first point. So A minus present value of B. Then we also know that from our hedging ratio concept, one option will not always be equal to one share. It can be different, right? It can be 0.5 share can be used to hedge one option, or 0.75 share can be used to hedge one option, or it can be 3 share. It can be any relationship. So that will be given us to by the hedging ratio. So the hedging ratio will tell us how many shares to be entered for creating a complete hedge. So can I rewrite this spot price multiplied by hedge ratio? This is A and this is B in my example. So A I am rewriting as spot price multiplied by hedge ratio, correct? Minus present value of strike price. I am keeping it as of now. So this modifies my formula till here. Now, this present value of strike price is also probability dependent, because there are chances that if the option becomes out of the money, there will be no present value of strike price. Only if it is in the money, then only I can expect the present value of strike price to come. In that case, the probability that spot price on expiry is higher than the strike price, I should multiply in my present value of strike price. Okay. The moment I do that, I am rewriting the formula like this: S, which is the spot price, ND1, which is the hedge ratio, minus X into e raised to power minus RT, which is the present value of strike price, which I will rewrite as X divided by this, and hence X raised to the power X into e raised to power minus RT, correct? And ND2 is the probability that spot price on expiry is higher than the strike price. This is the real essence of Black-Scholes model. Now we have to understand what is this ND1 and ND2. In this, S is equal to spot price, X is equal to strike price, ND1 is equal to normal distribution value of D1 and normal distribution value of D2 is ND2. Now, first of all, let us understand what is D1. D1 actually is given by this complex formula, which is a natural log of S by X, spot by strike, plus R plus volatility square divided by 2 into T divided by V underscore T. And D2 can be derived from D1. So this you have to remember. This formula we have to remember. Okay. Then natural log of S by X is actually the reverse of exponential function. We all know that exponential, so we can understand through this. E raised to the power A is equal to B. In that case, natural log of B will be A. So these are having the inverse relationship. This is also available from the natural log tables. The value of natural log S by X will be given from the natural log tables. So students, again, I'm saying all these things are actually discussed in very detail in the respective sessions. Okay. Then on the call option, we said that if spot price increases, premium will also increase because it will lead to higher natural log of S by X, which is higher D1, and hence ND1 will also be higher, S into ND1 will be higher, and hence premium will also be higher. So there is a complete chain that we have discussed. Higher volatility will mean higher ND1 and hence higher premium. Now we discussed about normal distribution. We said that what is normal distribution? Normal distribution gives us a probability as an output. if we input U, which is, this is average or called as mean, and standard deviation, it will help us to give us a probability. What is probability that price is 18? If historically I have this trend, the normal distribution will give us that what is the probability of price being 18 if I have average and standard deviation. Okay, so this is how the normal probability, normal distribution looks like. It's a bell-shaped curve. Okay, so in the middle is always mean, 50% of the items toward left and 50% of the items towards right. And area under this curve would be probability. Okay, and total area under this curve is 1. Since probability always is 1, so it is 1. Kaushik is saying technicality increase. Yes. Technically, it is increased. If the price, the spot price increases, the premium also increases in case of put option, in case of call option that we all know. For calculating the normal distribution, we always calculate a Z-score. Z-score is actually the price for which, or the observation for which you are trying to calculate the normal distribution minus average divided by standard deviation. And then this Z-score is actually looked into the normal distribution table to arrive at the percentage. Okay. So again, these things we have discussed, which I'm skipping as of now. We also said that 99.7% of the probability always falls in U minus the average minus 3 times of standard deviation and average plus 3 times of standard deviation. Then we discussed about the valuation technique of put option. In this case also, we have taken the case number, I think 4, in which we said that a person is selling a put option and selling shares in the spot market. With the same logic, we have built in this formula. In this case, the present value of the strike price multiplied by N minus D2. N minus D2 is the probability that the price would go down from the strike price, because the put option will become in the money only when the strike price, the spot price is coming down compared to the strike price. And then this is the hedge ratio, N minus D1, and S is the spot price. So again, I'm saying the logic building is remaining same. Only thing is the formula gets reversed for the valuing of the put option. Yes. So till now we have discussed forward future options, concept, hedging, speculation, and valuation, all 3 things for all of them. Now let's come to the last part. Apart from this, commodity derivatives and Greeks, I would not be covering. That we have already covered. In terms of the revision, those are very simple. I would be covering put call parity theory as the last topic of today's session, revisionary session. Okay. Still, I request if there are some unanswered or unclear doubts, please do again put it on the query handle so that I can take up them as well. So students, there is a put call parity theory. For that, we have again taken this example. Let's say the rate of return is 20%, strike price of the put option and call option is 180, and the spot price is 150. The premium of put option is 180, the premium of call option is 15. Okay, so let's take 2 different investors. The first investor, what they're doing is they're purchasing a put option at the rate of 10 rupees, correct? Because the premium is 10. The moment they purchase a put option, that means they are purchasing a right to sell. The right to sell they are purchasing, that means on exercising that right to sell, they need to sell the equity share, and hence they will have to invest currently in the spot price. So the initial cash outflow is minus 160. The initial spot price is 150, right? So they would be end up in paying 160 rupees. The second investor is actually interested in purchasing the call option at 15 rupees. Now, the moment the second investor purchases the call option at 15 rupees, the call option purchase means they're purchasing a right to purchase. That means on expiry, they will have to give the amount equivalent to the strike price. That means today only they will need to invest the present value of strike price, which is 180 divided by 1 plus 20%, which comes as 150. So hence 165 is the initial cash outflow. He's a call option holder and he's a put option holder. Now let's come to the subsequent cash flows. In case of subsequent cash flows, the price comes as 200. We have taken 3 options. The first option, let's say the closing price comes as 200. In first case, the put option holder will become out of the money. 180 is the strike price. Actual price is 200. So it will become out of the money. There is no cash flow here. And since they are holding the equity share itself, they will get 200 rupees and hence the overall cash flow will become 200. So this is investor 1. For investor 2, since the call option has been entered at 180, the price has become 200. There is a gain of 20 rupees on account of the option. And 150 rupees multiplied by 1.2, they will get on maturity, which is 180 rupees. Hence, the cash inflow will always be 200. So do you think in the first case, whenever price comes as 200, the cash inflows on maturity are same for both investor 1 and investor 2. Now let's take a second case where the price comes as 100. In this particular case, the put option holder will get benefit because 180 strike price, 100 actual price, 80 rupees will be the gain. And it will also sell the stock at 100 rupees. Ultimately, the gain will be 180 rupees. In this case, the call option is 0 will be because it will be out of the money. Strike price is 180. The price has gone down to 100. There is no benefit. But on the contrary, it will get a maturity amount of 180. The 150 will get redeemed at 180. So the output, or let's say the final inflow on expiry, will again be 180. Hence, as per the put call parity theory, the value of put plus spot price would always be equal to value of call plus present value of strike price. Why? Because if the ultimate cash flows are equal on settlement, that means their initial cash flows while they're entering into their respective portfolios would always be equal. So what will happen here? Let me tell. So this is investor 1. Sorry. And this is investor 2. So for investor 1, initial cash flow is 160 and 165. This is cash outflow. And this comprises of value of put and this comprises of value of call within this. Okay. The cash inflow case 1, case 2, we have taken, it is 200 here and here also it is 200. Here it was 180 and here also it was 180. So what put call parity theory is saying that if this is on settlement, right? This is on settlement. So on settlement, put call parity theory is saying is that for investor 1 and investor 2, if the cash flows are same, why would initially the cash outflows would be different? It won't be, because the market will operate in a parity. So value of put we have kept it as 10 and value of call we have kept it as 15. So value of put will slowly increase and value of call will slowly decrease, and let's say they will meet at 12.5. I'm just taking this an example. So because of the demand and supply equilibrium, because this portfolio which investor one has created, the demand of this will increase, correct? Because outflow is only 160 and inflow is same. Here outflow is higher, so here the demand will decrease. So it will come at a parity. So value of put and value of call will come in such a manner that the 160 will become, let's say, 162, and this 165 will also become 162, the initial cash flows. And hence, we have concluded that the initial cash flows will always be equal, which is value of put plus spot price. This is investor one, and value of call plus present value of strike price. This is investor two. This is the cash flows from the investor two's point of view. Any questions, students, till now on this put call parity theory? And this is very useful because let's say in the question, if we are given 3 out of this 4, then the fourth one can be calculated through this put call parity theory. So I think this was our last topic for today. Let me actually go back to those 4 cases that we have discussed and tie back all the things. Just a second. Yes, this one. So here I have given you 4 cases, correct? So now case 2 we have used in the Black-Scholes model for valuing the call option. Correct. Case 4 also we have used in Black-Scholes model for valuing the put option. Now remaining case 1 and case 3 we have used in to prove put call parity theory. Correct. Because in put call parity theory, the person is buying call option, which is case 1, and the another investor is buying put option, which is case 3. So students, with this, if there are any other queries unanswered, we are very happy to take them. Please do let us know. Yeah, I think with this we cover the revisionary aspects on derivatives. Again, I would like to reiterate, this is not a in-depth session. This is to revise the flow. Yeah. I would request, sir, you're there?
Yeah. Am I audible?
Yes, sir, you're audible.
Welcome, students. I think today's session on derivative revisionary class must be very fruitful to you, because I was watching, going through your queries, and your response was very good also. And thanks a lot, sir, Divas sir, for your because you have explained these cases in a unique manner. So thanks a lot for again to you for your all the effort that you have put into making this class successful.
Thank you, sir.
With this, the topic of derivative has been over. Now, next topic, we shall cover Forex as usual, hybrid mode. We are uploading the classes of SFM. This is Foreign Exchange Risk Management. You kindly go through the lecture, as well as assignment will be uploaded soon. Then after that, there will be a revisionary class. So in the end, as a customary, this is our email ID, sfm-final@ici.in, or this is my contact number. You can contact me in case of you have any issue. Okay, students, thanks for your patience listening. Keep learning, and see you after some time. Thank you. Thank you, Divas.
Thanks a lot.
Thanks a lot.
Thank you.